Welcome back, my friend. It is your best friend in stocks, options, and dividends. Checking in here live. We'll do it live. It is Tuesday, February 21st, 10:05 a.m. Central Standard Time. Hey, Bart, you're down over $6,600 today. That's a lot of money. That is a lot of money, but you know how we do. We're interested in the dividends and collecting those option premiums. So we call that income, don't we? Yeah, because why is that? Well, money rule number 3, cash flow is king, cash is queen, and debt is the joker. So we're looking for that cash flow. And I was looking at one of my friends today. That's Blackstone. Blackstone right here. They are down today 2.5%. Oh, over 2.5% now, Bart. So I wanted to take a closer look at that. I'm thinking about 3 to 4 different positions, starting with this Friday and then going out a week at a time, rolling down those strike prices to possibly put ourselves in a nice position in case Blackstone keeps traveling down the road. We'll be there to collect those shares at a lower price than this 9103. That's our idea. And remember, I am not a investing expert. In fact, I barely know what I'm doing. So do not take any of this as investing advice. This is for, entertainment purposes only. So we were in Memphis, Tennessee for a couple of days for the Coulter Wall concert for my 15-year-old son. Stopped by Graceland, stayed at the Peabody Hotel, visited Sun Studios, and we drove on over in a rental car over to Nashville, Tennessee, and hung out there for a few nights, had a good time. In fact, at one point, my son was called up on the stage to play Long-Haired Country Boy on the guitar, and he's only been playing for a few months. But our friend, our favorite entertainer in Nashville, Lefty Ferguson, who is also left-handed like my son, he took a one-song break, and my son played that song. So that was a great video. I'll share a part of that soon. Now back to the show. It's enough about your goofy family. So Blackstone. What were we saying? Oh, yeah, we like Blackstone a lot. It's down today, so why not sell some puts? Our current position, go back to that. Let's see what your current position is. We only have one contract open right now on Blackstone, and that was an $86 strike price that does expire on Friday. When we did sell that, we collected, I think, like 64 bucks. $65. Hey, there's an extra dollar. So we collected $65 when we sold that on February 10th, which, of course, if you are unfamiliar with options like I was just 2.5 months ago, if the stock drops to $86 or below, we will likely be put those shares and we'll have to buy 100 shares at $86 per share. So that would be $8,600 would be spent on those shares, which that's fine with me. I like Blackstone a lot. I love their CEO, Schwartzman. Hey, wasn't he in the movie A Christmas Story? I don't think that's the same guy there, Terry. But we have one position open. We currently own 0 shares of Blackstone. We owned, I think, 1,100 at one point. They all got called away. And we did make a small little profit on those. They got called away at higher prices than what we were in on them for. And we collected a nice amount of premium along the way. But let's take a look at Blackstone over here. One of the things we like, number one, Blackstone, it's down 2.71. So we're going to collect a little more premium based on that risk. Currently at $90.97, and the market's at what? Dow's down 426, S&P's down 1.25%, and NASDAQ down 215 points, 1.82%. We like Blackstone as a company long-term, undervalued according to Yahoo Finance, and we like that dividend, 4.7% on the divvy. We like to collect that along with the premium. If we look at the 3-month chart for Blackstone, what I was looking at specifically today is, what have you done for me lately? I was looking at the 20-day moving average, which would be that green line there, and it's at 94.64. And we're going to try to sell option contracts with strike prices at $88 and below, rolling our way out a few weeks. Over at Alpha Spread, they have the intrinsic value at 93.34, currently undervalued at 2%. So again, we're going to be trying to get in at $88 and lower on our strike prices. And if we get assigned those, so be it. We'll just start selling calls, won't we? And then Zach Morris and Screech over at Zacks.com, they have it as have Blackstone as a hold, which is a 3, and they have the scores as value at a C, growth at a B, and momentum as an F. But what does Screech know? He was barely saved by the bell. So let's head back over here, take a look at our friend Blackstone, and make our first move. And what's that going to be, Bart? I think we'll go out just till the end of the week on this first one, just to see what kind of action we can get. Sell, put, expiring February 24th. That's 3 days from now. That's right around the corner. That's Friday. Let's look at 88. So at 88 buck, $88 strike price, which would mean if we are assigned these shares, it'll cost us $8,800, but we will then own 100 shares of Blackstone, and that is part of our plan here. We want to own Blackstone long term, so we got to get back in on this, man. 45% implied volatility. That's what gives us a nice amount of premium. So we get 48 cents there at $88 strike. And if we do just a little bit of math, get the abacus out. So if we take 48 cents and we divide that by $88, okay, and then if we were able to do this type of trade, because it's only 3 days out, say we were able to do it 50 times a year, once a week, just under once a week, we'd be looking at a 27.2% return on our capital. So that's a lot of dollar bills, y'all. That's why we like trading the options on a high volatility underline like Blackstone. Let's look at, it's at a 21 delta, so approximately 21% chance that during these 3 days that Blackstone will go down to 88 or lower. And of course, if it does go lower, we would still be obligated to pay $88. You talking it could go to 87, you still have to pay 88? That's right, Terry. That's the risk. That is the risk, because there is somebody on the other end of this contract that's essentially betting against my feeling on this contract. But when it comes to options, what I see is this: selling puts and calls is kind of like being the casino. Buying puts and calls is kind of like being the gambler. So I'm a bit of a conservative gentleman. So let's look at collecting this, see what we're talking about. We'll just go with one contract right here. It's at a 48 to 52 spread. So can we just try for 49? I don't know. Try for it. It's an extra dollar bill, y'all. So if we click that, and there you see they'll hold $8,800 collateral during the 3 days that this trade will be in progress. And there we go. We just collected our $49. Make a little note, Bart. There's 49 at a strike of 88, expiring Friday. But I also wanted to look another week out. So if we look out at March 3rd, which is 10 days away, selling a put, can we roll it down? Can we roll it down? Rolling, rawhide, and still collect a nice premium. Let's look at, so we got the $86 put here next Friday, 81% chance of profit, 20 on the delta, and around the same volatility as well. But we'd collect $75 right now, right into our sweet pockets, and it'd be $2 cheaper per share. So that would, if I was put those shares, it would cost me $8,600 for the 100 shares of Blackstone. So let's go ahead and try for that. Let's see what the bid and ask is. Hey, wait a minute. You didn't even click it here. Continue. 75, continue. They've got a spread between 75 and 80. Let's just try another dollar. You know, every dollar counts, especially when your wife drinks so much Starbucks. She's got to get the vanilla double pump booty rump shaker lattes. So we're going to try for the 76 cents. They're going to hold $86 collateral, and it was filled. So there's $76 bills, y'all, at 86 strike, and that is a March 3rd expiration. And then again, if we do math on that particular contract, if we take the 76 cents and then we divide it by the $86, we get a 0.008. And then because this is 10 days out, say we're able to make that trade 26 times a year, what are we looking at? We're looking at 22.9% return on our investment, our invested capital, or in this case, our collateralized capital. So that's what we have there. And then let's look another week out. Let's look out another week to March 10th, which will be 17 days out. And let's roll down even further. So we're still selling puts on Blackstone, which is currently down 2.88% today. It's at $90.83 currently. And we're looking down. The last we sold was an 86. Can we get down to 84? We can. Get down to $84. Now, I have no idea, Blackstone could plummet and it could be at $70 through these contracts, and I'm buying them at the higher share price. Like if we go with the 84 strike, then and it closes at $80 through this expiration date, then I'm still paying $8,400 for those 100 shares. 45 on the implied volatility, a little bit lower. Delta 18, theta 06. So because it's 17 days out. So let's try it. Let's try it right here. See if we can put $90 in our pocket right there. So let's get out of that and then back into this $84, 90 cents a share, which will be $90 in our pocket. You like to collect that extra dollar, don't you? Let's see if we can't get another dollar bill for the Sparkle Barbie's Starbucks fund. Let's review that. They're going to hold $8,400 collateral this time because we are down at the $84 strike price based on 100 shares. Try for the $91 and see if that will be filled. And it is. There's $91 bills and 84 strike, and that would be a 310 on the expiration date. So what did we just put in our pockets? We put $49 plus $76 plus $91. So that's $216. That's not bad for 3 trades on a stock, a company that we like, Blackstone. So there we have it. A little bit of fun together on this Tuesday morning, 10:17 a.m. Central Standard Time. I'll be checking back in later. Thanks for watching. Make sure to subscribe to this lovable channel. Like as many videos as you possibly can. Leave as many comments. I will answer every single one of them because we are now new best friends in stocks, options, and dividends. See you in the next video.